Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. On today's show, I speak with Mike Vinokur. He's a portfolio manager with Propellus Wealth, that's part of IA Private Wealth. And he's a stock investor, but he's sitting on a mountain of cash. The percent of his portfolio that's in cash right now stands at an eye-watering 37%. We're going to find out why that is and what it would take for him to deploy it. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Once in a while, I get comments from people who say, I love the show, but I don't know how to get started investing. Let's fix that right now. First things first, you need to set up a trading account. There are two tax-efficient options that you can set up through your financial institution. First is the TFSA. You can put away $7,000 every year. And if you've never had a TFSA, you now have $102,000 in contribution room as of 2025 if you were 18 or older in 2008. This is great if you want flexibility and any gains in this account are not taxed. Second is your RRSP. This is a great vehicle for saving for retirement. You can contribute up to 18% of last year's income up to a maximum of $32,490, and that can be deducted from your income taxes. Okay, so now you've set up your accounts, you need a trading platform like BMO InvestorLine. The dashboard's pretty intuitive. The News and Markets tab provides beginner-friendly market insights. If you're curious about a stock, look it up, and you'll have access to research that billion-dollar fund managers read. That's the thing they don't tell you about zero-commission brokerages. Zero commission, but limited available research. You'll be able to easily move your money from one account to another, consolidating all your investments in one place. And when you are ready to buy that stock, bond, ETF, or mutual fund, you can do that all under the Trade tab. It's just that simple. Find a stock you like and add to cart. And right now, if you sign up for BMO InvestorLine, you can get up to $3,500 cash back. Visit BMO.com/InvestorLine to get started. So open that account, make that first trade, and tell us when you do. You can hit us up anywhere on social media at In the Money Pod, and let's help you get a little more in the money. Mike Vinokur, thanks so much for being on the show.
Pleasure to be here.
I've had the pleasure of interviewing you several times, so I kind of know your style, but I was shocked to see how much cash you are holding in the portfolio. Tell us how much cash you're holding.
So in our equity model specifically, it's approximately 37% right now.
That's high.
It is high.
Why is it? Okay, first, I do want to know why, but I want to know how high is it relative to previous points in your investment career?
I think this is about as high as we've gotten, if memory serves. Maybe we went to a little bit higher than, well, actually, no. I think during the pandemic, we may have gone a little bit higher than that, maybe closer to 40 or just eclipsing 40. But I mean, we're not striving to be in cash. We just follow a philosophy, unlike many of our competitors who say you always have to be invested. We just don't follow that kind of mantra. Cash is an asset class, especially when cash is not trash, especially when, on Canadian dollars, we can get paid, say, 2.7 to 2.8% with zero risk. On US cash, we're getting 4.25 today, 4.5. So
this is because you've invested in a bond market.
Bond or high interest savings accounts or, money market equivalents, if you will. And so at the end of the day, we need a margin of safety. If we can't have a margin of safety to take on risk, then why are we taking on risk? So at the end of the day, it's not about we're in cash because we need to be in cash. We're in cash because we've cashed out of certain equity investments and we're now looking to reload at hopefully a much lower level in terms of valuation.
Okay, so that's like when you're sitting on that much cash, it does signal, and by the way, you're not the only one. Look at Warren Buffett's cash pile, which has been growing. It sits at a record north of $345 billion. Talk to me about why you're there, the why of how you got there.
Right. So in Q4 of last year, we wrote to our clients and we said, and this is before the whole temper tantrum with the trade war and whatever. We said, look, we think that we may be in the 8th inning of this economic expansion. We think that, DOGE is going to come in and is going to cut government spending. Well, government spending was in the US part of what was juicing the GDP number, right? So you start taking that back and then you start saying to yourself, well, if people start thinking about job loss or economic slowdown, what is it going to do to their spending? And of course, Europe had already been in sort of its own, mired in its own slowdown recession. And so we thought, valuations are not cheap. Back then, if you recall, I was on the air, I think it was November 11th, actually, and the S&P had hit 61 and change. And I said, I think we're getting pretty toppy here. Not that I knew that it was going to be the top or close to the top, but it was close. And so for us, it's about valuations. People, there's this recency bias I worry about because the last 10, 15 years with ZIRP and all this free
Zero
money.
interest rate policy.
Yes, thank you. And all this free money floating around, people look at the NASDAQ and the tech sector and they say, wow, all I have to do is buy the market and that's the quick road to riches. But, I'm a student of history, and while history doesn't repeat, it does rhyme, in our opinion. And so if you go back into periods like the 60s and 70s, or you go back into the 80s and 90s, you had periods where valuations did matter, and it wasn't growth at any price. And you had people like Warren Buffett who, people called him an old dinosaur in 1999. He doesn't know what he's talking about. He's buying oil and gas and energy when oil is at $10. What is he thinking? Well, lo and behold, 3 years later, boy, was he smart. And the people that held, growthy tech stocks were in pain.
I want to underline a point that you were having this conversation at the end of 2024 when people might have thought the last 2 years were great in the stock market. This year, it's going to be the same because Donald Trump is going to usher in all kinds of business-friendly measures. And instead, we're getting tariffs. But I wonder if the markets would have been vulnerable regardless. Because, was that part of your thinking that tariffs were going to be it? Or are tariffs really just an excuse? Would something have taken the markets down anyway, just because of what you say, valuations?
That was our thinking. We just didn't think that it could have been as violent as it was, say, in the month of April because of the news cycle. But we believe that eventually valuations matter, especially when cash in the US is paying you 4.25%. You got to worry about the equity premium. In other words, how much are equity investors really getting paid for taking on equity risk versus going to a T-bill? And there's that little interplay. And we believe that that interplay is coming back in full force because there's this maybe realization in the market that, hey, valuations do matter. And risk reward, maybe we want to make sure that we understand what we own as opposed to just believing in this, unending growth.
So you mentioned the sell-off in April was violent, and it was until it was just as violent to the upside. We saw a market that almost plunged to a bear market in April and then also rallied 10% from that low. That speaks to so much volatility, but also maybe that FOMO. Everybody has been so trained over the last 10, 15 years, these dips are meant to be bought. Did you buy those dips, or are you still in the camp that valuations haven't come back far low enough?
So we didn't buy the dip in April. We did buy some dips in March. So if you look at the S&P 500 and the NASDAQ, for example, I think those markets peaked sometime January, February. We took advantage of a very big one-day correction in December to load up in our portfolios. And then into January and February, we started selling off certain positions and raising cash. We did trade around some core positions in March, but I did not foresee April coming, that's for sure. Having said that, if you look at the range from a technical perspective, the S&P peaked at somewhere around 6130, 6140, somewhere in there. And I think the intraday low, I think we hit it April 7th, was 48, 4900, somewhere in there, close to a bear market if it had closed there. So call it 20%. So from a technical analysis perspective, it's not unreasonable to believe that you make back 50 to 60% of the prior move.
Which we have.
Right. So 20% down gives you 10, 12% up. So here we are. And so we expected that the bounce would take the market to between 55.50 to 57.50, maybe 57.80 at the edges. Could it blow through that and keep going to 61, 6,200? Of course, anything is possible. But at the end of the day, what are the drivers that are going to do it? Because in the past 2 years, to your point, you had these Mag 7 stocks with their trillions of market cap pushing the average index. And we kind of think that that game may be at least over for now or on pause to a degree. And you've got to have the soldiers propping up the generals, right? And we're not seeing that right now. What we're seeing is a big rotation in the market. And we'll see where the bulls and the bears duke it out and find sort of an equalization level until the next move.
So one of the areas you're parking is cash as a hedge on some of this volatility that we're seeing in the U.S. But one thing a lot more people are talking about is the end of U.S. exceptionalism and this idea that the next 5 to 10 years are going to be about returns outside of the United States. What do you think about that?
I'm not convinced. Saying that the US, which has probably the most entrepreneurial spirit, still a very solid rule of law, very deep markets, very deep venture capital, raising capabilities. I don't know. I'm not convinced. You could make the argument that there are very cheap markets out there. For example, I think I saw an article on the Brazilian market trading at 4.5 or 5 times earnings. You could argue that's quite cheap, but maybe it's cheap for a reason. Now, there is an argument to be made. And I think that your statement needs to be taken into context. Exceptionalism in the US business market, I don't think is over. Might it be temporarily over in the US stock market with a massive correction to create a reset so that you can have the next bull market? That would be more akin to our view. I think that business formation, business creation, business productivity, efficiency, capitalistic tendencies, I don't think they're gone from the US, but I do believe that we are in for some more corrective sort of action in the US market.
So where does that leave Canada?
Economically, I think we're going into a recession. I've been saying to colleagues and clients that I kind of feel like the last real recession this country has had was 1990, 91. We haven't had a real bad recession. We sort of skipped, the recession.
Isn't that good? Maybe we just don't do that anymore.
Well, perhaps, but it doesn't have to be a really bad one, right? It's not about, oh my God, 15, 20% unemployment type of recession. It really does. I hope it doesn't go that way. But what I do think is you need to wring out the excess, right?
Okay, let me interrupt you there because I would argue that the last 10 years have been like pretty economically, I don't know if I can swear, but I'll say like shitty. They haven't been great. So it's not, where is the excess in Canada?
Well, if you look at GDP per capita, you're absolutely right. On a per capita basis, it's been kind of crappy. You're right. But the country has been growing, and my concern has been that if you look at the mix of our GDP, I think I saw stats that said something like 20% of Canada's GDP was related to real estate. Like, that's a lot. And so maybe that's because we've overbuilt. Look at all the condos in our city, probably around the country. Look at all the, housing that has gone up in price so much over the last 10 or 15 years. You could make the argument, and the IMF has been making the argument, that we've got super overpriced real estate, residential real estate. So maybe that comes home to roost a little bit. And so I think that the real estate market in Canada and maybe some other areas where we've got some excess needs to get wringed out of the system.
I want to tie real estate to the stock market because in Canada, it's a little trickier to do. It's not, there's a lot of easy ways to play the housing market in the US through the stock market. In Canada, you have the banks, you have some alternative lenders, but you don't have builders and stuff like that. But to your point, we are seeing a slowdown in the housing market. Sales are dropping, prices are dropping, listings are going up. How does that wash up on the shores of public market equities, if at all?
I'm not sure that it does so much, because I think the Canadian banks, which are something like 35 to 40% of the Canadian equity market cap, let's say, plus, let's say, the life cos, I don't think they have so much exposure anymore. And the exposure that they have, I think, is really prime, or it's CMHC, so it's really insured for them. Now, they do have commercial and industrial loans, obviously, and that's always the business risk, but they manage that fairly well, and they're very well capitalized. And really, our market is not as domestically focused on the domestic economy as maybe the US market is, though you could argue that the US market, I think something like 30% of the S&P 500 revenue comes from abroad. But our market is more dependent on commodities, on the price of gold, on exports, so we have a lot of car manufacturing in Ontario, for example, auto parts. So obviously right now that's a hot topic. We've got utilities, we've got telecommunications, right? So I think our TSX equity market is not as directly impacted by the domestic Canadian economy as maybe some other equity markets around the world may.
There's a funny thing that happens in markets when we're talking a recession. Obviously it goes down leading into a recession, but sometimes the equity market looks past that and starts to rally, even though the economic numbers are not great. Where are we in that sort of cycle, that sort of habit of the stock market?
So you're asking only the easy questions.
Yes.
Okay. That's a tough one to answer, because the truth is nobody knows. I don't have a perfect crystal ball. I would say that the Canadian market has been doing a lot of catch up to the US market, sort of like global markets have. And if you look at the forward earnings numbers on the Canadian stocks, they're not doing too badly. I mean, they're holding in. We'll see how at the margin this tariff trade deal, whether a USMCA gets renegotiated or whatnot, and how that filters in to the earnings of the TSX. But at the end of the day, you're absolutely right. Markets do bottom when the news is horrific, because they do see past the bad news into the next cycle. And, Charlie Munger used to say he never met a wealthy pessimist, right? So that sort of talks about the psychology of markets and market participants and how they need to think. And I always joke with my clients that when I get nervous, that's when I know I have to be buying, because chances are, even though it's nerve-wracking, that's probably the bottom or close to the bottom. Right now, I'm not nervous, partially because I have so much cash, but partially because I feel like the valuations are nowhere close, especially in the US market and especially in the tech sector, let's say, that gives me that itch to pull the trigger and say, oh my God, I have to buy this now.
That's great. Let's dip into the mailbag, because we're going to see if you're being ultra selective, what passes the test.
Sure.
Okay, our first question is on the Brookfield web, as they call it. Would you own both Brookfield and Brookfield Asset Management, which are two different stocks, ticker BN or BAM, or would you just focus on one? Or would you look at one of their other subsidiaries? There's a bunch of other Brookfields out there, like Renewable. Let's say a 5 to 10 year time horizon. This one coming from LaFlemme123 on X.
Full disclosure, we do not own any of the Brookfield entities, whether it's BN Brookfield Corp or BAM, which is the Brookfield Asset Management arm, or any of the others.
Why?
So first of all, phenomenally managed company. I can't say anything bad about the business. I just don't like the valuation. I think that the market has convinced themselves that private equity fund flows are just going to keep on going. And I am at this point concerned, and not necessarily with Brookfield, but just all private equity players, whether you're talking KKR or Apollo or Carlyle or Blackstone and Brookfield in the mix, that there's going to be some marks on the books. And with respect to Brookfield Infrastructure and Brookfield Renewable Power, our concern has always been that when you look at the FFO,
funds from operations.
Yes, fund flows from operations. And then you back out all of the depreciation expense, which is really, eventually there's a cost, right? It's a nice tax play at the beginning, but then there's a cost. And then you back out the dividend. There's no real free cash flow except for their gain on sale. So then the question is, well, can they continue building and selling these assets for these massive capital gains to keep on, keep the machine going, if you will? And our concern is that if we do hit some kind of a road bump or a recession or a liquidity squeeze, the answer may be no. And in that case, we don't like to buy businesses where the dividend is not supported by the actual cash flow generated by the business and is reliant on these transactions all the time.
It's interesting you're cautious on private equity. The concern, the markets in public markets, they get marked down in real time, but that's not true for private equity. They sometimes take their time about it and it takes months to see how much that has come down. There's also this additional concern that these big endowment funds in the US, universities like Harvard, because they're in a cash crunch due to the US administration and policies by Trump basically withholding funding, that they have to all of a sudden flood the market and start selling some of their private equity investments. Is that a concern here for the whole space?
I think it could be. I mean, I can't speak to the underwriting of each of the private equity players and how they've underwritten their various investments and what industries and obviously it depends on what industry and exposures you have and how much the underlying businesses, how much leverage they have and on what covenants and terms. But there is this overriding feeling that I have that a lot of these players took money when it was really cheap because of COVID and leveraged up a lot of these balance sheets or extended these balance sheets into 2025, 2026. So if you do get that slowdown, even at the margin, I wonder where the cracks are going to start appearing and to your point, what percentage marks these books are going to have to take.
Let's go to our second question. This one coming from Mike on Fairfax Financial. This one coming from Clay on Twitter, asking Mike, which is you, about Fairfax Financial. What an absolute beast of a stock.
Unbelievable. Prem has done such an amazing job. It's no wonder they call him the Warren Buffett of Canada. I'm still kicking myself for not buying some stock when I could at $1,200 or $1,300. Here we are. I think it's 21 or 2150.
$2,200 now, another all-time high.
Yeah. Again, it's this is a very, very well-run machine. But at this price, I wonder if, there's enough margin of safety for a value investor. I think that they are
Which is funny because Prem will say he's a value investor.
Right. But he's not necessarily buying his own stock at 2,200. He's taking the cash and buying other businesses that he thinks are cheap. Yeah, I mean, listen, if you're going to hold this thing for the next 10 or 15 years, and I wonder who Prem's successor may be. I don't know how old Prem is, but like Warren Buffett, I wonder if he's got some lieutenants that are ready to take the reins and continue this very enviable track record that he's created.
He's 74, so if he works, he's got another 20 years.
20 years, there you go.
Warren Buffett retired at 94.
So, if you have that 20-year time frame, potentially it's a good return. The thing is that from this level and from this valuation, I just don't know what kind of compounded annual growth rate one could expect from the equity.
Okay, let's squeeze in one more question before we get to break. And that question is on Cummins. I'd love Mike's take on Cummins. It had a nice roll, but has really tailed off this year. Is that because as an engine maker, it's caught in the tariff-related downturn of transportation stocks? Should I expect it to languish because of that? This one coming from Trevor in Toronto.
So I think Cummins is a very well-run company, and they certainly make a really good engine. I think when you look at a company like Cummins, you are really making a bet on economic expansion versus economic contraction. I mean, that's, and the valuation, obviously. The stock has run up quite a bit on some euphoria, and I fear that perhaps there's a lot of pull forward in the industrial business, probably because of tariff-related worries. And I don't know that they manufacture 100% of their components in the US. I think they do a lot of it, but I think they also import a lot of parts. When I looked at the technicals and the seasonal period of strength, we're sort of past it. I think it's between December and March. So, on a short-term basis, my view is unless the economy really rebounds into Q2 and Q3 and everybody becomes very euphoric about the industrial sector, don't have a lot of expectations of a company like Cummins from the perspective of earnings growth and investor expectations. Having said that, if you're looking for a very well-run business that has a good moat around it, that's got a great brand, and that will continually, more than likely, in an expanding economy, grow earnings, then Cummins is probably a great place to park some of your capital for the very long term.
We're going to take a quick break and dip back into the mailbag. But before we do, I want to bring you a conversation I had with Jamie Coulter. He's the CEO of Raymond James Canada, which is one of our sponsors. And we talked about how the company is helping clients navigate turmoil in the markets emanating from tensions between Canada and the US. With 25 years of experience, not just in Canada, that also spans a number of market cycles. And right now we're in a market cycle where there's a lot of panic, let's be honest, to go around. How are your clients feeling?
You point out that this is not new in some respects. And so my team and I think that, and remind ourselves that we live in a VUCA world. And you'll say, well, what's VUCA? Well, it's an acronym and it stands for volatility, uncertainty, complexity, and ambiguity. And so if you accept that, and accept that in any one year you're going to have a mix of headwinds and tailwinds, you're not surprised. And so you're sort of thinking long term. And so what we're trying to do on two fronts here in a VUCA world is take care of our clients, and through, support them through investment research, support our advisors, make sure the advisors are calling their clients. On the investment research piece, it is national in sort of North American in scope. So our Canadian strategist is working with his counterpart in the US. We've got a Washington policy analyst, Ed Mills. He's been pretty busy, as you'd expect. And then on top of that, we're looking again for opportunities to continue to invest in our platform so that we can continue serving our clients here in Canada.
And how does that manifest in tools that Canadians can use?
Our communications team in the last couple of weeks is a tariff resource center. And so if you log into the raymondjames.ca website today, it's featured right on that homepage, also shows up on our client app. And so what we're trying to do is make it easy for our clients to access all that research that I was just talking about. It's all bundled into one spot, readily accessible, client-friendly. And then hopefully that spurs conversations back with their advisors and check in. And really when you're checking in is, am I going to be okay? And if you've got a good financial plan, you're going to have a pretty good sense of where you are you on track or not, make adjustments along the way. That seems to be working.
Okay, we're back. We're dipping into the mailbag. This question is on Uber, which reported quarterly results. The question is coming from Panet on Twitter. And if memory serves, the results showed a bit of a slowdown in rideshare growth. Still high, 20%, but that was
Almost
slower.
20, yeah.
That was lower than the 24%. And maybe just a stock that's falling only because it's run up so much. How do you think about Uber?
So I like Uber a lot. Full disclosure, we did own Uber. We sold Uber into the run up, probably a little too early. Should have held it into earnings. We like Dara. I mean, Dara is a great operator.
The CEO.
Yes, the CEO of Uber. I think he and his team are doing a phenomenal job. But to your point, revenue growth is slowing down. And they reported operating income this quarter of $1.2 billion. So if you multiply that out and add a little bit of growth and you normalize operating income to say $6 billion, I believe the market cap is somewhere in the $180 billion range. So you're talking about a 30x multiple on operating income. Maybe free cash flow is a little bit more due to some accounting. It's getting a little bit frothy for our value bent, just because to maintain that kind of valuation and underwrite a higher stock price, you need to foresee revenue growth reaccelerating probably into the mid 20% range. And if we are now at the cusp of, airlines talking about a slowdown in ticket sales and, a slowdown in travel overall, I would imagine, I'm not 100% sure, but I would imagine a big part of Uber's business is travel, whether it's from out-of-towners going to point in a city, or whether it's, people from the city going to the airport and then hitching a ride back from the airport. But either way, if travel is coming down and at the margin, a lot of their business is travel, then how does that hurt the growth story?
And I think the CEO, Dara Khosrowshahi, said in an interview that if they're seeing a slowdown, it's mainly US, whereas international markets seem undented. So that could be, we know that there's even there's hard evidence to suggest that Canadians are not traveling to the US. So that could be the same true. The same could be said of other people from different countries going to the US.
Exactly. But, the other piece of this story is, how is the integration of Waymo? They're doing a lot of test piloting with Waymo and other autonomous vehicles. How much capital is that going to take? How much mindshare is that going to take? How long is it going to take for that to be profitable? There's a new company I actually found out about that operates here in the GTA called Hop, which I never heard about, but I heard about it from an Uber driver because I was getting a ride.
And is it autonomous?
No, it's not autonomous, but it's a direct competitor to Uber. So now you've got Uber, Hop, and Lyft. And this gentleman said, well, I'm on all three, right? And so that begged the question to me is, okay, well, how hard or easy is it to have a startup directly compete with Uber and offer the same kind of rideshare service? And how good is Uber's moat really? I don't know the answer to that, but our feeling was, the valuation was getting too rich and the margin of safety was sort of ebbing for us to find out.
Okay, so still staying away from Uber, though it sounds like you clocked in a nice gain on the stock. This next one we'll, have to be sensitive about the timing on this because we're filming on a Wednesday. It's going to come out on Thursday. It's BCE. We have a question on. It's due to report earnings. The earnings, I think, matter less than what are they going to do with the dividend. It's currently yielding 13.5%, but the market is betting that they are going to cut that dividend by 50% in the next 24 hours. How do you think about owning BCE, about it cutting its dividend?
So we haven't owned BCE. I don't think I've ever owned BCE, actually.
Why?
So telcos in general are a very capital intensive business. And so I've found in the past, you have to own them at very distinct points of time in their CapEx cycle. because if you get in at the wrong CapEx cycle, there is not a lot of free cash flow, and all you get may be the dividend. And telcos and utilities in general, I've found, are very sensitive to interest rate moves. So at the end of the day, I mean, I remember getting a new client and he had BC. I sold it for him at $63. We were just talking about it the other day. And, at the time it was yielding 4.5% or 5%. And, interest rates were so low. And he said, well, I'm making 4.5%, 5%. And I said, well, it's about the return of your capital, not the return necessarily on your capital. Because
and you saved him because the stock is cut in half from that level.
Luckily, absolutely. So I would say that if you are a long-term thinker, maybe now at these valuations is the time to think about having some exposure to the telecommunications sector, because they're unloved, they're beaten up. They've got all these negative narratives about, there's going to be less people in the country, which means they're going to have less customers and all of that stuff. Okay, so that's the negative. What about the positive? Well, the positive is they've all already spent a lot of money on their CapEx cycle. I mean, there's still a little bit more to go, but, they're all into their 5G and fiber and whatever. And if you believe that, immigration is going to start up again, we are going to maybe have 300,000-400,000 people coming into this country on a consistent basis, then these businesses are going to be able to grow. I think the market is right. I think there is a 50% dividend cut coming. I think it would be smart. And I hope that nobody is buying this stock thinking they're going to get a 13.5% yield forever, because in our view, that would be foolish thinking.
Do you buy it after they cut the dividend?
We do not. We own one telco, and that is Rogers.
Which honestly also has struggled. BC gets beaten up a lot.
100%. They've all been struggling. We just like the mix of Rogers businesses better than BCE. We think the management is better. We think they have had a much more sustainable dividend policy forever and a day. And we think that the upcycle is going to treat Rogers better to a degree than it's going to treat BCE. Having said that, at this valuation level, BCE is probably not a bad bet, but we've already made our bet in that space.
Let's squeeze in one more question here. This one on Financial 15 Split-Corp. I have a question for Mike on this company. What is his outlook on the strategy in this macro environment? This one coming from Kyle on Twitter. Can you spend a beat just explaining what this entity is and why investors own it?
Sure. So Split-Corps are interesting animals. They usually issue shares at $25. Typically 15 of the 25 is what's called a pref share, where the pref shareholders get X percentage on their $15. Not guaranteed. It's a yield. It's a yield play. And then the other $10 part of the split goes and buys equities. Sometimes they do covered call writing. And they use that $15 of the pref share to go and buy those equities. So in essence, it's almost like a leveraged play, because you're using the pref share part of the split to acquire $15 more on top of the $10 of your equity. So it's like you're buying $25 worth of stock with $10. That's like 1.5 times leverage. And you are paying for that leverage by guaranteeing the pref shareholders a dividend. Okay. So then you have to make the bet that the dividend that you're paying to the pref shareholder is going to be equal to or less than the dividend that you're going to obtain from the underlying holdings of the companies. And the covered call writing premiums are going to generate enough money after all of that and the management fees that the company that runs these things takes to pay out this distribution. And what I have found in the past is that if you like the sector that's underlying the actual split share that the companies are buying, you're better off just buying the ETF. without this structure. Because yes, while the yield is very appealing, what happens a lot of the time is they don't variably reduce the yield when the markets go down, and they're still paying out the same amount of money, but they're not generating that cash flow, and that eats at your NAV.
Yes.
And in some of these structures, you have to be very careful, because if your NAV goes below a certain point, they stop paying distributions. They have to protect the preferred shareholders. The preferred shareholders sometimes gets reset at either higher or low. So there's a lot of moving parts. I'm not saying don't own it. I'm saying you have to know when to own these things, and you want to buy them at a discount to their net asset value. And if you're able to buy something at a discount to net asset value, then perhaps there's a reason to own them. But I would say if you like the banks, if you like the life cos, buy that ETF, gain that exposure.
Okay, before we get to ProPix, I want to ask about one of your holdings, which is Parkland. I don't even know how to describe what's happening at Parkland. So there's an activist battle, there's a proxy battle, and in between, when it looked like the activist was going to win and overthrow the board sold the company to Sunoco. And that deal still needs to be approved by shareholders, but the meeting is not happening. It was supposed to happen this week. It's now not happening till June 24th. You're a shareholder in Parkland. That's a lot of drama. The offer on the table is a premium if you take the all cash version. What do you think about it?
It's definitely a lot of drama, to your point. There's something to be said about shareholder governance. And I think that given that, from my read of it, 60% of shareholders voted the gold proxy, which sided with Simpson Oil, which is the 19.9% shareholder of Parkland. It was a very sly and underhanded move by the current board, even though they were in strategic alternatives. I get all of that. They were looking to sell the company. They put that out there, and it was all public knowledge. However, when the shareholders tell you that they want board rejuvenation, that they no longer are confident in the current board and their actions, to go and not give them that opportunity at the AGM to ratify the new makeup of the board and set up new governance structures, it tells you a little bit about the board. And about who's leading the board and how they're looking after shareholders. And it's a little bit concerning. I think at the end of the day, this will all play out one way, shape, or form, because the assets are worth a lot more than where the stock is trading. We've been holders for that reason. We think that the sum of the parts is worth even more than $44. And I'm hoping that somebody else comes to the plate and offers a much bigger offer. I could see high 40s, even low 50s to the right buyer to squeeze out the efficiencies and the productivity of the business and make it worth their while.
If that doesn't come to the table, you have a decision to make as a shareholder, whether or not you want to approve this transaction. Do you know how you'd vote?
I do.
Can you tell me?
I would approve the transaction only because I fear that at this point, if the deal doesn't go through, it's going to take the market a long time to get the stock price to where it needs to go or should go. And I think that there's better places to park my capital at this point. And plus, we did pay mid-30s. So at $44 in a couple of years, plus the dividend, is not a terrible return for us being patient shareholders.
All right, well, let's find out where your conviction lies. We're going to dip into ProPix now. ProPix is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Your first pro pick, and I'm so glad you brought this because I have a lot of questions. It's on Alphabet, which seems like such a safe tech play. But I am so deeply involved with ChatGPT now that I am wondering if this safe tech play is actually super vulnerable to generative AI in a way that maybe wasn't immediately clear when ChatGPT first came out.
So I'm not a technology expert. And so I'm going to say, I don't know if over the long term they are vulnerable. What I do know is that technology has evolved for the last 25 years, and Google or Alphabet has not been at the backseat of the bus. They've been driving the bus. They are at the forefront of what is going on. And I would like to believe that their Gemini AI system is going to still drive what brings in, for now, the most amount of money, which is search. Secondly, I have used ChatGPT, and I have used some other LLM models, and I must say that they're not, for search purposes, necessarily as good or as quick as what I will use when I just go into my Google browser.
Really?
And yeah, they're not, it depends on the case, but they're not as good as I thought they would be. So I don't think that overnight people are just going to start using ChatGPT for their search queries. And, when you look at Alphabet, this is like a mini conglomerate, right? I mean, you've got YouTube, you've got Waymo, you've got Willow, which hopefully, I don't know when it comes out, but that could be a game changer for them. You've got their cloud infrastructure business. They're investing more in their AI infrastructure business as we speak. You've got their Google Docs, which my kids use. I don't use, but the kids, they're on the Google Cloud. So I think that there's a big fortress moat around this business for the time being, and I think it's going to give them time to figure out how to maintain a certain piece of that moat.
Willow, for those who aren't familiar, it's a quantum chip that they're developing. Quantum was hot for a hot minute. But, the promise maybe is 10, 20 years plus away. The other sort of cloud over Alphabet is regulatory and whether or not the company gets broken up. And I've heard a lot of people say, like, so what?
Yeah.
What are you in that camp? So what if it gets broken up?
Absolutely. In fact, a lot of times conglomerates have the conglomerate discount in their stock prices. And perhaps if you broke out some of the pieces of the pie, it may get a very supersized valuation because people get excited about the future of that one component.
Let's talk where you fair value, where you think Google should be trading. It's around 150 right now.
I would say 195 to 210, somewhere in there, is probably
just a few months ago.
Yeah, exactly.
Okay, your second company is interesting. It is Air Lease, and actually had really great earnings this week. It popped. Talk to me about what the business is and why you find it attractive.
So it's a very simple business. They lease aircraft to airliners. So they're typical, sort of like a bank, if you will, a lessor, right? They lease equipment, and it's longer term leases, and the equipment is very expensive. And because they have such an amazing relationship with basically an oligopoly, which is Airbus and Boeing, they have locked up their new inventory for the next 5 or 6 years. So even if you're an airliner and you'd like to call Boeing and say, hey, I'd like to buy that plane, they may say, sorry, we don't have the capacity, because companies like Air Lease have already paid for orders and locked up contracts in advance. And a lot of times airliners don't want to buy their aircraft. They want to lease it.
So a slowdown in air travel does what to an air lease? Nothing.
Well, I don't want to say nothing, but generally speaking, airliners, well, it's like your car, whether your car sits on your driveway or whether you're driving to work, unless you want to give up the car, you're going to pay the lease. So it's a piece of equipment that they have to pay their lease on. If they don't pay their lease, Air Lease is going to repossess the equipment. I would like to believe that airliners, when they take on a lease of 5 or 10 years, it's because they want that newer piece of equipment that's fresher, newer, more fuel efficient, and will allow them to continue running their business.
The question I have is on upside. It seems like around $51, $52 per share, Air Lease taps out. At least it's done that over the last couple of years. It's broken slightly above that. Now it's at 53. Do you think that's a breakout?
So today, by buying the stock at $52, $53, you're not only buying it at well below book value, and this is recent book value, but you're buying an enterprise that has guaranteed lease payments coming to it over the next 5 or 10 years, and the profitability that goes along with it.
Does that book value, does that gap, has that always been the case, or is this kind of a newish phenomenon? Like the book value has steadily increased over 5 years, even as the stock is tapped out at that same level?
Yeah, so I think that over the last 2-3 years, that's been a sort of bigger phenomenon, because of the aftermath of COVID and the supply chain issues and what's going on. And also, of course, don't forget that when interest rates went from 0 to 5.5 or wherever they tapped out at in the US market, a company like this, which has, $20 billion of debt, right? The market could get worried that their cost of funding may go up a lot. If you believe, as we do, that markets rates have probably peaked and are probably going to come down, there's actually a potentially huge opportunity for Air Lease to refinance some of their debt and maybe over time get their average interest rate cost down, which really would fall straight to the bottom line.
Let's get your third pick, Lincoln National, kind of a financial services, kind of smaller cap too,
Yep.
And a little bit more beaten up. How do you see this one unfolding?
So Lincoln is a life co. They do asset management, they do retirement services, annuities, life insurance. We love the life insurance business. It's a very steady cash flow generation business. What I particularly like about life insurance is that if somebody stops paying their premiums, the liability on the company's balance sheet disappears because the policy lapses. And so all of the premiums that they received and had to reserve for the eventual death or disability or whatever just goes away. Now, obviously that lowers the revenues, but it also lowers the liability and it all falls into, retained earnings, let's say. So when you're buying a company, when you look at the balance sheet of this company in Q4 of 24, the stated book value per the company was somewhere in the $72 range. Okay. Now, there's a lot of
It's trading at 33, just for perspective.
It's trading at 33, right? Now, there's a lot of reasons why book value fell, having to do with their investment book and how interest rates went up. And so their bond prices went down. And so they had to remark and all of that stuff. And then there was a remarking on some of the costs of their policies and whatnot. But
so that was back in 2022, right?
Yeah, 2022,
yeah, 2023. It was like a big drop in the stock.
It was a huge drop, right? But now that we are where we are, and you also had a turnover of management, right? But here are the positives. You get a pretty decent dividend. You have a pretty good earnings stream. I think they're going to earn roughly $7.50, maybe $8 a share over the next year and growing from there. You've got a lot of free cash flow, and their RBC, which is their risk-based capital, is, I believe, somewhere in the 420 to 430% range, which is very high. And so they have the capacity to keep on buying stock. And when you buy back stock at such a fraction of your book value, it becomes very accretive. Now, they did pause buybacks for a while because they wanted to rebuild capital and there was a change in the CEO. But I have a feeling that any day now, they're going to be able to relaunch massive amounts of buybacks. And I think that's going to be extremely accretive.
So it sounds like it was a really messy story for a while, but you think it's gotten cleaned up and about to get way better.
Absolutely.
Mike, thanks so much for joining me. What a great conversation.
Pleasure to be here. Thanks for having me.
That's Mike Vinokur joining me. Make sure you tune in to our next episode. We've got Dan Niles on the show. He is a very well-known tech investor. We're going to go deep into the tech sector, find out what he likes, what he's avoiding. Actually, he was pretty vocal about avoiding tech stocks at the beginning of the year. You can send in your questions to questions@inthemoneypod.com. Go to our website, inthemoneypod.com, to submit a question or hit us up anywhere on social media @InTheMoneyPod. And we'll catch you on the next episode.